Hi, everyone. This is Paul Garrard. I'm founder and president of PGPresents, an independent student loan consulting company. We've put together a series of repayment modules to help you guys do a better job of managing your student loans. Module number 12 is on refinancing your student loans with a private lender. Now, in theory, private refinancing is similar to federal consolidation in that you're trading debt for debt. You're paying off multiple loans with one brand new loan. But with federal consolidation, you're paying off multiple federal loans with one brand new federal loan. With private refinancing, you're paying off multiple loans with a private loan with a private lender. Clearly, the incentive to do this, or the bait, if you will, is to try to get a lower rate on your student loan portfolio when compared to the rate on your federal loans or any private loans you're also considering refinancing. Now, all the lenders have their own lending criteria for approval and pricing, but in general, they are going to look at least three things: credit, your debt to income ratio, called DTI, and your employment history. You may find after going through this module that it is a bit risky to do refinancing during residency, even for the lenders who are offering what we call token payments during your residency training. But we're going to address that in this module. There are advantages and disadvantages to private refinancing, and we want to go through those with you right now. Now, obviously, the main advantage to refinancing with a private lender is to get some substantial savings in terms of repayment by getting a lower interest rate on your student loan portfolio. That's the incentive to do this. But there are some disadvantages to refinancing with a private lender. And the main one really is losing the repayment flexibility that you have with federal loans that you just don't have with private loans. You may not like the interest rates that you have on your federal loans, but you have a lot of repayment flexibility in terms of postponement options and repayment options with federal loans that you just don't have with private loans. Certainly, if you refinance your federal loans with a private lender, you are taking the Public Service Loan Forgiveness Program off the table because PSLF only applies, as you know, to federal direct loans. And once you refinance, you can't go back and undo that. So that is a look at the main advantage of refinancing, potential substantial savings compared with the disadvantages, the loss of repayment flexibility, and certainly the elimination of the possibility of qualifying for the Public Service Loan Forgiveness Program. So let's take a look at whether or not you should refinance your student loans, federal and or private. You may be a candidate to refinance if you're ready to actively start paying on your loans, perhaps aggressively, and maybe you don't need or you just don't want to use an income plan. You may also be a candidate for refinancing if you are simply not interested in the Public Service Loan Forgiveness Program, because like we said on the earlier slide, once you refinance, PSLF is off the table and you can't get that back. You may also be a candidate if you're just not concerned about having to postpone payments during your residency and fellowship training if you're doing a fellowship, because you have those options available on federal loans, and you'll find that they're limited, if available at all, on private loans. You may also be a candidate to refinance if you have strong credit, a favorable debt to income ratio, and a solid employment history. But look at that last one. That sounds a lot like an attending physician, perhaps not a first-year resident. But you may not be a candidate for refinancing with a private lender if you want to start making payments during training, but you need those payments to be low and you need to be cautious with how much you're paying every month. Because during training, that is likely to be the period of time when there's a big gap between what you've borrowed and what your income is with your stipend. So if you need an income plan like pay or repay, you're not going to be a candidate for refinancing. You'll also not be a candidate for refinancing if public service loan forgiveness is on the table as part of your repayment strategy. If you're going to start making payments to qualify and evaluate this every year, you certainly do not want to refinance, because once again, refinancing with a private lender takes PSLF off the table. You may also not be a candidate for refinancing if you think you may need to postpone payments during training because those options are available on federal loans and they may not be available on private refinance loans. That depends on the lender. And you may not be a candidate for refinancing if you are simply risk averse. You do not want to give up the flexibility you have on your federal loans for a private loan. Now, if you decide to pursue refinancing, there are a series of questions we would encourage you to ask of any private lender you're looking at for a refinance loan. Certainly ask about the interest rates. That's the main reason you're looking at refinancing anyway. Ask about fixed versus variable rates. And some of the lenders are now offering what are called hybrid rates, where they're fixed for a period of time and variable for a period of time. If you're interested in a variable rate loan, be sure you find out what the maximum and minimum rates are. In other words, how high can that interest rate go? You also want to find out how often the rate is reset. You can expect it to be reset on a monthly or quarterly basis, and you always want to know how much notice you're given about the interest rate change because that can impact your monthly loan payment. Also ask about repayment options. Remember, the repayment options are going to likely be based on a term of 5, 7, 10, perhaps 12 or 15 years. That depends on the lender. And in most all cases, the shorter the term you take, the better interest rate you're going to get. Also ask about postponement options, especially if you're considering doing this during your residency training, including a fellowship program. Be sure that if they do allow postponement, there are no fees attached to doing that. There's never a fee to postpone payment on federal loans with, for example, the mandatory residency forbearance. But find out, are there any postponement options available? Also find out if a cosigner is required on your loan, or even if a cosigner is not required, if you could secure one, could you get a better interest rate by bringing on a cosigner? And if you do have a cosigner, ask about what's called the cosigner release provisions. This is simply a provision whereby if you have a cosigner signed on the loan, after a designated period of on-time payments, usually 24 or 36, you can apply with the private lender to have your cosigner dropped off the obligation for the loan. Because remember, if you have a cosigner, that is showing on his or her credit report as an obligation. And then find out about forgiveness provisions. We are not talking about public service loan forgiveness. We're simply talking about death or disability. In the unfortunate event of your death or disability, federal loans are forgiven. Be sure you ask about the provisions that may be attached to this on a private refinance loan. There are some lenders we understand that are now offering this, but be sure you ask about this, especially if you have a family. And just a few more questions. Always ask about the assumptions behind any kind of projected savings amounts they give you. If they give you an amount of projected savings, be sure it's on your portfolio and not on some boilerplate portfolio they have on their website. And then finally, very important, we understand that pre-approvals do not result in any kind of a hard pull, or as they call it, a ding on your credit report. So be sure if you're talking to a private lender about doing a pre-approval, just to find out if you can be approved and what kind of rate you could qualify for, be sure that is what is called a soft pull on your credit, and your private lender should be able to answer that question for you. Now, a few more comments as we close up this module on refinancing. Once you do this, you can't undo it. So like we said earlier, if you refinance your federal loans with a private lender, you've taken the income plans off the table, and you certainly have taken eligibility for the public service loan forgiveness off the table, and you can't undo that. Now, you don't have to refinance all of your loans. We've worked with some borrowers who have some very high interest rate private loans from college, and they have a lot of federal debt from medical school, and they want to refinance just the private loans from college at a lower rate. You certainly can do that. Talk with the private lender you're looking at about refinancing just your private loans, perhaps from college. Don't commit to a challenging cash flow just to get a lower rate. What we're trying to say here is we mentioned that the shorter the term, the repayment term, the better rate you're likely to get. That's the way mortgages work. But don't commit to a shorter term just to get a lower rate if that's going to result in a very high monthly payment. Remember that one of the objectives for many medical residents is to find a repayment plan or a term or a loan where the monthly payment minimum required is very manageable and comfortable, and then they can overpay. So once again, don't commit to really challenging cash flow where you have no wiggle room at all in your budget just to get a really low rate with a refinance loan. And carefully consider whether token payments are worth it. We are trying to be very cautious about this. There are some private lenders we know of who are offering what I call a token payment of around $100 during residency, and certainly that's a manageable payment and perhaps good for them for offering that. But remember, you can usually get quite low payments with the income plans during residency, payments that would count toward the public service loan forgiveness program. So I guess the theory there is, why go with a token payment of $100 on a private loan that won't qualify for public service when you could get a relatively low payment with an income plan on your federal loans that would qualify for public service loan forgiveness? And please remember that private student loan debt is not factored into income payments for a spouse. You may recall from a previous module that if you're married and your spouse's income is being counted in the determination of your monthly payment, if your spouse has federal student loans, that is also factored in. But if they have private loans, their income is counted, but their private student loan debt is not. Very important to remember that. This is the end of module number 12.